We have officially entered a bear market, which means a lot of people are really scared of the stock market right now. The market's dropped a ton lately, and people, including myself, are losing money at an alarming rate. The question is, what do we do and what does all this mean? If we're just going to continue losing money in the stock market, then we should stop doing it, right? It doesn't make any sense. We'll need to find something else. But if there is some kind of hope that we could keep making money in the stock market, then maybe we should stay there. It just feels really unlikely right now. To really know how to sort through this kind of conflicting environment, we need to answer 3 questions. Number 1, what does it mean that we're in a bear market right now? Number 2, is a recession coming? And number 3, what then can we do as investors with this information? It's really important that we know what's going on behind all the doom and gloom that's on the news so that we make the right decision with our money. Number 1, what does it mean that we're in a bear market right now? Well, first off, it has nothing to do with Beats or Battlestar Galactica. Instead, a bear market is just a time when the stock market goes down by at least 20% from a recent all-time high. There's nothing special about that number. It's just a milestone that was chosen at that 20% mark, and it was given a name. For some people, that could be cause to panic. Whenever you look at the chart overall, you can see that the stock market actually looks like this, and it doesn't look like this. And so that means that it's not actually time to panic. See, because the stock market looks like this, it means that it's regularly hitting all-time highs. And it's really not uncommon for there to be downturns after hitting all-time highs. In fact, that's really expected. And no one can predict really when that's going to happen to any kind of precise degree, but it's always something that's part of the equation when we're investing in the stock market. Since the end of World War II, there's been a bear market about every 5.5 years. But so you know, the average bear market is actually a lot worse than just a 20% drop like we've experienced so far this year. On average, during a bear market, stocks drop 36%, and that period lasts around 10 months. So we may very well be seeing things get worse before they get better, which leads us to question 2. Are we headed for a recession? Well, maybe. Thankfully, though, a bear market is not the same thing as a recession, and it doesn't necessarily mean a recession is for sure coming. So we're all on the same page. A recession is a little bit more loosely defined than that very specific 20% mark in the bear market definition. A recession is a significant decline in economic activity that is spread across the economy and that lasts more than a few months. Yeah, that doesn't really mean anything to me either. That's super vague. I don't know what that means. So I had to look it up. Technically, I learned that there's one specific group that decides if we're in a recession, and they generally measure kind of 4 factors. If those things are bad enough, then they stamp it recession. But a bear market doesn't mean that those 4 factors are necessarily like really, really bad. In fact, right now, they're not terrible. Since 1929, there's actually been 26 bear markets, but only 15 recessions. So this may or may not be one of those times where a recession follows the bear market. If you do want to get really nerdy about this and do some extra reading, I've linked a blog post all about that in the description. So if you want to put on your nerd glasses and learn a bunch more, by all means, go ahead. Based on the available indicators as of right now, we're still a little ways off from a recession. The problem is, though, inflation just hit 40-year highs, and you can't just let inflation run amok. That would be like letting loose a whole herd of nifflers in a jewelry store. It's not going to end well. And we can already see now some of the effects of inflation. It's pushing up the prices of everything from eggs to cars to houses and everything in between, and it's happening at a crazy rate. Stuff is so expensive now. So our government here in the US and in central banks around the world is going to do whatever it takes to slow inflation down. That's why you've probably heard that headline about the Fed raising rates. That's what they're doing in this effort to slow inflation. And as they're doing that, it probably will slow inflation down, but it will also slow the economy down. See, it's this really tricky balancing act, because if they raise rates really fast and a lot, then they're going to throw us into a recession for sure, because they make money that much more expensive to get, they slow down economic activity, and it puts us into this recession. Not good. But on the other hand, if they raise rates too little or too slowly, then inflation continues to build, and that also hurts a lot of people. So that means the only way they win at that game is by raising rates at that perfect middle Goldilocks amount, just right in the middle. And of course, that's a really difficult balance to strike. As of this moment, no one can predict the future perfectly, but I think that it's fair to expect either one of those outcomes. Inflation could remain high for quite a while, or we could experience a recession. Either one at this point is totally viable. Okay, Brendan, that's all fine and good, but how do we handle our money right now? What do we do today? Well, this is where I think we actually have reason to be hopeful, funnily enough, and here's why. First, the stock market has never gone down and stayed down forever, like ever in the history of the stock market. It's never done that. Since 1928, there's been 26 of these bear market downward trends, and there's been 27 recoveries. The next cause for optimism is just how short-lived these time periods are, where it's down like this. On average, a bear market is going down like it is right now for between 9 and 12 months. Since our all-time high ended on January 4th when stocks started dropping, that's kind of our starting point for that time period. So that means 9 to 12 months from January, we should hit rock bottom. That means somewhere in the winter of 2022 or maybe really early 2023, we should see the bottom of these prices and kind of reach the lowest it's gonna reach for the time being. For the average bear market, the time it took for stocks to drop, bottom out, and then come all the way back up and reach that previous all-time high again is 27 months. So then to me, that means if this is an average cycle and we hit a low this winter, then that means starting at the very beginning of 2023, we're in for a wildly profitable ride back up out of this trough. People are gonna make a lot of money. That could be you and me. And if that average bear market cycle continues, then we'll be back up to all-time highs by summer of 2024. But the fun shouldn't end there. And that's the third reason why we should be hopeful. Because the average length of a bull market, which is where the stock market is up 20% from a previous low, is 2.7 years long. This is incredible news, because that means not only does the market spend more time going up than it does going down, but it goes up over time, even as those little steps happen like we're in right now. It doesn't feel little, but it's little. The little steps down happen, then it spends more time going up and it reaches all-time highs again. So that tells me we may be in for a very positive trend even well past 2024. Yeah, bro, but how much does it even go up? Like, how much money am I gonna make? Well, on average, stocks lose 36% of their value in a bear market. That's not good. But in contrast, in the bull market that follows, stocks on average gain over 110%. I like the sound of that. And that's the fourth reason we can be hopeful, is if we do the right thing now, we stand to make a lot of money when that recovery happens. In fact, based on my research, half of the S&P 500 strongest days in the last 20 years occurred during a bear market. That's crazy. And another 34% of the market's best days took place in the first 2 months of a bull market. Those are really crazy numbers, because what that tells me is by the time everyone realizes that the market is going back up, it's too late. They've missed out on a bunch of the gains. People are already making tons of money in this time period when the average person still thinks the stock market is going down. A lot of people, and this may be you, have just started investing for the first time in the last 2 or 3 years. That means this is likely your very first bear market, and it sucks. I'm with you. But assuming something like a 50-year investment time horizon, we could be in for another 10 bear markets. As we look at our account balances just fall and fall and fall in recent months, it's been really difficult, but I think this is something like a strength that we need to build up to be able to see this happening and hold the course. It's not irregular, the sky isn't falling, it's okay. The important thing for us to remember in times like this is that overall, markets are positive most of the time. Over the last 92 years of the stock market existing, only 20 of them have been bear market territory. That means that stocks have been on the rise 78% of the time. And realistically, the only way we stand to benefit from that is being invested, staying invested. So, how do we invest today? Hey, quick interjection here with today's secret comment. The secret comment word is bull. I'll keep an eye out for you dropping the bull emoji or mentioning the word bull in your comment, because these are my favorite comments by far. Here's 5 tips on how to invest today in the midst of a really scary stock market. Number 1, don't take your money out. All that does now that the stock market has fallen is ensure that you have actually lost that money and there's no hope of regaining it. If you've already done that, don't blow the money on gelato and Porsches to ease your pain. Instead, you need to look at step 2. Number 2 is continue to invest. Or if you already sold out of your investments, think about reinvesting that money. Despite the emotional burden of that and how scary or how silly that might feel, based on the numbers and based on everything that's ever happened in the history of the stock market, that's the right move. Number 3, when should we do this? How do we know when we should actually take action on that? Don't wait. Because if we wait until we're already in what's a confirmed bull market, that means that the stock prices have gone up 20% since recent lows, and by then tons of money has already been made. In fact, most of the money has probably already been made. So that's too late. Don't wait for things to turn around. The only way that we can ensure that we're on that wave, we get to ride that thing all the way back up and make all that money in the meantime, is to be invested as early as possible. It's really dangerous to try and pick and choose those specific moments when you should be invested or not. And so the best thing for us to do by the numbers is to invest early and often. Number 4, where do we invest? Okay, that's a tough one. Popular tech stocks and all these companies that blew up during the pandemic have now blown up in the opposite direction, and crypto is even worse. Those were probably the 2 most popular areas to invest in here recently, and now they're probably the most scary. You can do whatever you want because it's your money, and frankly, that's your prerogative, not mine. But by the numbers, people do better by investing in a lot of companies instead of just cherry picking a few here and there that they think are going to do really well. And I'm not suggesting picking out 10 or 11 companies that you are optimistic about compared to just 1 or 2. I'm saying investing in thousands of companies the easiest way possible. Which leads us to number 5, which is the boring, not sexy, but often referenced and recommended 3-fund portfolio. All that means is it's a mix of 3 different investment funds that break things up so that you invest in thousands and thousands of companies all at the same time. The first one is a US total stock market index fund that covers every public company in the US stock market. The second fund is a total international stock fund, so you're investing in everything else that's outside of the United States. And the third one is a total bond market fund that basically invests in all of the bonds all at the same time for you with just the click of a button. And just to make this as easy as possible, here are a list of these funds broken up by the different brokerage company, depending on who you're investing with or who you want to invest with. I want this to be really easy for you so you can see this list right up front. This first one I'm showing you is a list of ETFs. So each one of these is an example of a 3-fund portfolio. It just depends on if you want to use iShares or Charles Schwab or State Street or Vanguard. All of these are using ETFs. All of these are broken out by those companies so that you can make sure and pick the ones that work for you. And this second list is the same kind of investments, the same 3-fund portfolio. It's just broken out using mutual funds instead of ETFs. So you can see you've got a lot of options here, from Charles Schwab to Fidelity to T. Rowe Price and more. So now you know about bear markets and recessions, and you know that you can take action now to be invested and ride that wave up. But how do you know which one of those groups you should choose, ETFs or mutual funds? Well, thankfully I've made this video here which describes the difference between those and the pros and cons. Some of them are going to cost you a lot of money, others are going to save you a lot of money. So watch this video now to learn the difference so that you can get started investing as soon as possible.